Hello and welcome to TS Lombard. The bond market was always poised to sell before the US elections, but Trump's victory brought forward the time when the big bond bear came out of its cave. But what do higher yields mean for stocks? Well, all else equal, higher interest rates are a bad thing for equities. A higher discount rate means a lower present value of future cash flows. Better carrying fixed income assets makes equities less appealing at the margin. And higher funding costs eventually hit the bottom line for corporates. But all else is not equal, and each of these three arguments can easily be countered. If higher yields are accompanied by stronger growth, then earnings are expected to grow faster as well, which means that the performance for the stock market might continue to do okay. While there's been a sell-off in treasuries making yields more appealing to investors, it is true that the earnings yield for stocks is still well in excess of the yield on treasuries and even on investment-grade credit. And finally, yes, higher yields will eventually hit the bottom line for corporates in terms of higher funding costs, but this will take a long time to come through, since the average maturity for investment-grade credit is in excess of 10 years. But significantly higher yields and higher inflation means that there will be winners and losers at the sector level. Now, generally speaking, a reflationary environment tends to be unfavorable for bond-like sectors such as telecoms and utilities. Real estate also tends to perform rather poorly because of the importance of leverage and funding costs in the property business. On the other hand, sector where companies can easily pass costs, or higher costs, I should say, to their customers, are normally faring pretty well in an inflationary environment. And sectors such as consumer discretionary and healthcare normally fall in this category. Financials are the most likely winners in this environment because the relationship between bond yields and outperformance of banks versus the S&P 500 has been consistently stable over the years. Energy materials should also do okay in an environment where inflation is picking up. Now, the good news is that the cumulative market cap for the winners is close to 50%. In the S&P, whereas the losers only account for less than 20%. And this suggests that, on balance, higher inflation is going to be a net positive for stocks.